Hi everyone, welcome to a new video series titled Investing 101 with Dr. Peng. Join with me today is none other than Dr. Peng Chen, Senior Advisor to Provident. Hi Dr. Peng, great to have you here today.
Hi Isaac, this is great to be here.
Yeah, nice to see you. So in this 5-part series, Dr. Peng and I will be talking about important investing concepts, namely inflation, equity, bonds, gold, and expected returns. We hope that after listening to this series, all of you will have a better understanding of the financial markets and gain more confidence to start or continue investing. Today's episode will be about inflation, which is a hot topic since 2022 when inflation rates spiked sharply. So Dr. Peng, what is inflation and what are the causes of inflation?
Sure. Based on the definition, inflation is basically the increase in general prices that consumer faces. So in other words, if we look at all the prices we pay for the goods and services we buy or consume, when the price go up, and that would be called inflation.
Yeah, so what causes inflation then?
So inflation, as you can see, is represented by the basket of goods and services we consume or we buy, purchase. And so depends on the different goods and services. In general, if we look at the inflation, it's really caused by two main factors. One is the supply, one is the demand. So for any given goods or services, there's a supply, there's a demand. When supply and demand meet, that's when the price is determined. So when there's more supply than demand, typically price goes down. But when there's more demand than supply, the price goes up.
So is it safe to say that the current inflation, high inflation that we're experiencing is because of high demand, or is it because of a lower supply?
I think it's a little bit of both. So if you look at, because we've been, like you mentioned, entering into a relatively high inflationary period for almost 2 years. And actually inflation has coming down a bit since earlier this year and late last year. So if you look at the last 2 years, I think it's a bit of both on the supply side as well as on the demand side that push the price a little bit higher. On the supply side, if you would remember, 2 years ago, we were still in the midst of COVID, and the supply chain and so forth was somewhat disrupted. And also during that time, it was the beginning of the Russian and Ukraine conflict, right? Yeah. And so that also causes some disruption on various commodities, agricultural prices. So when you have disruption on the supply side, it causes supply to shrink a little bit, and when people are still consuming, for example, foods, energy, and so forth, so that naturally pushed the price up a little bit. So that's on the supply side, Isaac. But if you look at on the demand side, it's also very interesting. So during the COVID, in Singapore, we would have remembered the government came out with relatively strong economic, physical stimulus. Many people got a check, right, that to subsidize our income so that we can go out and spend, because many people are experiencing some challenges in to go to work and so on and so forth. So not only Singapore did that, U.S., China, many other countries did that physical stimulus. And what happened is basically government is putting more money into individuals and households' hand. So with more money, we can do more things. But one of the things it does is that increase demand, right? So when we have more money, we go out, consume more. We want more goods and services that drive up demand, and that also contribute to the increase in price.
Right. To your point also, when we are all stuck at home during COVID, we also probably don't spend as much as well, which also increase the savings that are in our account on top of the stimulus checks that many consumers receive.
Yeah.
Right. So how does inflation affects an investor's portfolio or their journey, right? I mean, every time we look at the news, financial news, there's always a lot of fear on high sustained inflation.
Yes.
So why is it so scary for an investor?
Yeah, I wouldn't necessarily call it scary, but it's a very serious issue that people need to be very much aware of. This is because inflation is a measure of purchasing power. And so when there's high inflation, it basically means the money we have today in terms of purchasing power going forward is going to decrease or diminish. And so that created a scenario where the money is worth less tomorrow. And so, when we think about investing, as you pointed out, we are all about managing risk and gain the returns. So when inflation is high, it means that our return needs to be even higher to keep up with the purchasing power decreases. So typically makes the investment side of things a little bit more challenging. And so that's why I think, and also I should add that the inflation impacts everybody. Right, so it's not like, okay, I invest in this asset or I invest in that, it doesn't impact me. Actually, it impacts everybody. So when it comes to long-term investing, inflation is often one of the first things we look at, because at the end of the day, just like how we advise Provident clients, investing is really about helping you better achieve your life goals. And life goals certainly are impacted by inflation.
Yeah, to your point, it's all about real returns, right? So if let's
Correct.
say your portfolio returns are 7%, but if inflation is at 5%, essentially your real returns is 2%.
Correct.
Yeah.
So if you look at the past few years, before 2022, inflation was really,
rock bottom.
very low. Yeah, very low, rock bottom.
Yeah.
Certainly, around 1%. And so if you look at returns, let's say, as you mentioned, if we generated 7 or 8% return, that just means that each year our purchasing power and the real returns increase by 6 to 7. But if you look at the top of the 2022 and 2023 inflation figure, it's also 6 and 7%. And that means whatever returns we generate is pretty much all consumed by inflation. And in some cases, if your returns are lower, you're actually overall losing purchasing power. And that's not something we like to see.
Right. So central banks around the world, especially in the developed world, they aim to get inflation at about 2%. I mean,
Correct.
it's an arbitrary number. That they feel that is a number. They feel that it is not is enough to stimulate spending. To encourage people to spend money, but not too high that the long term effects is not so severe. So in response to the high inflation that we have been facing, central banks have increased interest rates, right?
Yes.
So with this higher interest rate environment, right, we see that fixed deposits are giving 3 to 4% per year.
Mm-hmm.
Should investors invest their money in, put all their money into cash-like products such as fixed deposit or treasury bills, since it's giving quite decent, essentially risk-free returns?
Yes. So I would say that it's a very good observation. Because of the high inflationary environment, the central bank across the board has increased the interest rate. And what it resolved to, and when they central bank, they control the short-term interest rate. So basically the very short term, and what you observe is absolutely true, that the fixed deposit that banks offer, as well as the short-term bonds that you can invest in the government bonds and the high-quality investment-grade bonds, are all having a much higher yield or interest rate right now. And in that sense, it definitely makes them more attractive. So if you have a very short-term investment-oriented portfolio, then the short-term bonds and fixed deposit are definitely more attractive. But on the other hand, I think for most investors, certainly most investors that Provident deal with, that these investors typically have a much longer investment horizon. So typically 5 years plus, or even 10 years or plus, depends on the investment goals. Many of our clients have retirement as the number one goal. So when you look at from that perspective, the short-term interest rate increase does help on the short end a little bit, but it doesn't necessarily change the long-term expected returns or risk and trade-offs of the long-term investment horizon. So on this side, so I would still recommend the investors that facing longer-term investment horizon with long-term goals, still build a very diversified portfolio, take advantage of the long-term premiums that offered in the marketplace, such as equity market premium and so forth, and continue to invest in a diversified and long-term way, rather than putting all their money into a short-term fixed deposit.
Right. So what you mentioned was something like reinvestment risk, essentially, right? So
Correct.
if let's say they buy T-bills or fixed deposit, right? So they get, say, 4% this year. But you cannot really project that they will get 4% every year, because we don't know what the short-term interest rates will be a year from now, right?
Yeah, actually, you're absolutely right. So one of the things that if you, for a long-term investor to only invest in short-term fixed deposit is exactly what you talked about. They might be able to get a relatively decent rate of return like 4%, over a short period of time, maybe it's 3 months or 6 months, but over 5 to 10 years, there's a lot of uncertainty of where that short-term rate of return will be. And as a matter of fact, if you look at the current yield curve, it's relatively flat, and earlier this year it's even inverted, which point out that over time, that long-term actually the interest rate is going to go lower or and so forth. So, like I said, for long-term investors, when you have a longer time horizon, when you don't necessarily need the money and in the short term, which means you can take on a little bit more risk, it's much better off to invest in a diversified portfolio that take advantage of what the long-term market can offer to you in terms of return and manage risk in a diversified way.
Right. But for short-term money, it's like, let's say people want to invest or rather save towards renovation goals.
Yeah. So, like you said, if I want to renovate my, HDB, or if I want to take a vacation, around the end of the year to Europe, these are short-term goals that it's perfectly fine to put it into a fixed deposit or a short-term bond portfolio, diversified bond fund. And those are very good choices. Like I said, with the current interest rate environment, even in a higher inflation environment, the short-term rates are very attractive. Yeah.
Right. So I'm going to put you on the spot here. Okay. So will this high, or rather, this elevated inflation rate remain, or do we expect it to come down? With the central bank manage to get it back closer to 2%?
Right. So as you mentioned, that the U.S. Fed has stated very clearly in recent years they target a roughly 2% inflation, and as you mentioned, target 2% is beneficial to for the economy a little bit. When there has been high inflation in the last 2 years, it's very difficult to predict, and as you know, and Provident really don't have a strong forecasting element in terms of how we do things. That being said, I think in terms of inflation, if you look at what's the current central bank, their ability and their determination, and they have really learned from the history. What I mean is back in the 70s and early 80s, where inflation was high as double digit and really caused a lot of trouble in the global economic system. And so I think since then, the global central banks have learned, and they have acted typically very quickly and forcefully against expected inflation, because that's what's mattered. And so personally, I would expect them to to be able to manage things and get inflation down for the most part. And as a matter of fact, you can see the trending line of inflation has been coming down and has been coming down from the 6+% to 3 to 3.5% in the recent readings. So maybe not quite as low as 2%, but certainly much better than the 6% that we have seen.
Yeah, it seems like it's when we zoom out, it's trending down, but it's a bumpy road.
Correct.
Seems like
correct.
Yeah.
Because, like I said, it's a market, and in today's market, there's been factors that disrupting the global supply and demand, and we haven't even mentioned the global geopolitical tension between China and U.S., which both market,
huge.
Yeah, U.S. is the biggest economy as well as the stock and bond market globally, and China is the second largest economy, second largest stock and bond market. So when you have tensions in there, there's going to be disruptions, particularly on the supply chain and so forth.
Okay, thanks, Dr. Peng. So lastly, what actions should investors take regarding inflation? Now that we see inflation was high, it's trending, albeit in a very bumpy way downwards, so what should we do?
Yes, so there are a few things that investor can take into consideration. Like we mentioned, number one is stick to your long-term investment approach. Continue to build a diversified portfolio. For some of the investors that are investing in the Provident portfolio, we have already taken this into consideration by looking at some of these asset classes that offer a little bit better protection on inflation. So, for example, inflation-indexed bonds is one of the things we looked at and potentially can benefit investors. But for the most part, I don't necessarily, given the current environment, I don't think for long-term investors there's too much that you need to worry about or too much you needed to do.
Okay, so that's all for this week's episode. Thank you so much for your time and insights today, Dr. Peng.
Thank you, Isaac. It's great to be here.
To all our listeners, we hope that you found this session useful in understanding the impact of inflation and how we should approach dealing with it. If you like this episode, please subscribe to our channel and so that you don't miss out on the next few episodes where we will be talking about equities, bonds, gold, and expected returns. So as always, thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations, and other information broadcasted, or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives, and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal, or tax professional before taking any action. Provident Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted, or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Provident Limited.